Good Tuesday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, all the way from Center City, Philadelphia, Dimitri Parkamanek. How you doing, D?
Good morning, Will. How are you?
Good.
Uh, so good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. There's the disclaimer.
Excellent.
Let me share my screen here. While I'm doing that, if you're joining us for the first time, Will and I, we do these shows in the morning to try to help answer questions you may have about the Market Chameleon tools, the data, or the analytics. If you have a question, type it into the live chat on YouTube. Will's watching it. He'll read it back to me. And we're going to take a couple minutes to give you a chance to type in those questions and take a look at the pre-market report and see if we could get some insights, what's going on in the pre-market hours. So let's start with the pre-market report. We have up top a calendar view, and this does allow you to go back to a historical date if you wish to see what happened in the pre-market hours on that specific date. We also show up top here the last week of pre-market activity, a summary of what happened. So you could kind of eyeball and see if you could spot any types of patterns or trends. Today, we're on February 6th. And so far in the pre-market hours, what we're seeing is we got 505 stocks that are trading higher and 259 stocks trading lower in a pre-market. We have 177 million shares trading on up volume versus 43.2 million shares trading on down volume. If we convert all that volume to dollar value, we have $4.4 billion worth of stock trading higher versus 1 billion stock trading lower. So from that perspective, it looks like the trading in the pre-market hours has a bullish lean. Let's look at it from a couple more perspectives, and then we'll move on to our questions. So coming down here, now we see a list of stock symbols that are trading in the pre-market hours along with the price changes, volume, and some alerts. We have a list of our most active stocks, our biggest percentage gainers and biggest percentage decliners. Down here, I see 92 stocks made our percentage gainers list, 42 on our largest decliners list. And to make this specific list, we do set thresholds for liquidity, volume, price changes, because things in the pre-market trade with less liquidity, less volume. And to make this list, as long as the stock is listed on a major US exchange and meets those thresholds, it could make it onto this list. And that includes ETFs, leverage products, could be an inverse ETF, preferred stock, and so forth. So to narrow down this list further, we could use the filters here above. If you have a watch list and you saved a group of stocks that you're following into a watch list, you could use this filter. We're going to use this filter next to it in ETF. And click on it, you get a drop-down menu of different ETFs to select from. We're going to choose the first one, SPY, and click on it. The list below gets filtered by stocks that are holdings in SPY, which are the S&P 500 constituents. And here we see 13 stocks made our biggest percentage gainers list, and 7 met the threshold for our largest decliners. So that also points to a more bullish lean in the pre-market trading. And Will, we did give it a couple minutes, so if we have questions, I will take them now.
Yeah, nothing's popped up yet, D.
Okay. In that case, what we'll do is we'll continue on. Let me go to SPY. And I think we had a good question yesterday, but I do believe we finished answering that question. I don't remember if there was a follow-up. I know I think it had to do with the market on close order imbalances. But I believe we talked about it to the end.
Yeah, we did.
On SPY last week, we were going through this activity tab, and just a quick recap. I don't think I went all the way through. And this, what this page does is it takes the volume in the stock symbol, that you're looking at, in this case SPY, and it tries to explain some of that option volume away, because options are different than stock. You have different options, expirations, you have different strikes, you have multi-leg trades, single leg trades, and this is a breakdown of that option volume on a day. And this is from yesterday's option volume. Today we're not open yet, so once we open up today on a 15-minute delay, this report will start accumulating new data and breaking down that volume. So you could see here the breakdown between single leg, multi-leg contingent trades, split between calls and puts. Then we broke down the options by their different expirations, starting from the shortest dated to the longest dated options, going all the way out here. We talked about the at the money IV, the change in the at the money IV. We talked about the volatility skew, which I think we finished that up last week. So the next one coming down is then looking at the volume per expiration. And here we see that we have the amount of contracts that traded to the corresponding options expiration. So yesterday, February 5th, that was the 0 DTE option. It expired the same day, traded 3.9 million option contracts, and that represented 44.9% of all the volume in SPY. So big concentration of the trading is in the 0 DTEs. Then the next day, February 6th, that would be 1 dates to expiration, 1.5 million contracts traded, and that was 17.8% of all the volume that traded in SPY. So you could see here that yesterday's numbers, and I think this is pretty consistent from day to day if you watch this report, is that the largest concentration of volume is in those very short dated options, 0 DT, and then the 1 day to expiration as well account for the majority of that volume. And if we scroll down here, we see, the rest of the volumes kind of, distributed, but I guess it just tailors off as you go out further. That's what it looks like too. So that gives us kind of a real quick view where most of the volume's trading, and maybe something pops out. You check here, there is an interesting one here, February 16th, 5.5%. Let's look at the leaps, and it doesn't look like we see the amount of contracts, but as far as percentage of all the volume, it's very low. So let's say now we want to go and dig deeper into the volume on that expiration. So when you see this blue hyperlink, you could click on it. So when you click on it, it will generate a report at the bottom like this. So you could see here, there's the table, generates a report here at the bottom. And this is for the February 6th expiration that I clicked on. And here we get a similar breakdown that on this February 6th expiration, we could see that the amount of volume that traded just in single leg orders, just simple call or put, meaning it wasn't a multi-leg order or contingent, 76% of the volume is in the single leg orders. And the breakdown of that is 55% calls, 45% puts. Then we go to the multi-leg, and 24% of it, almost a quarter of all the volume, involved a multi-leg trade. So that could be, it could be a call spread, a put spread, even a time spread where one of the legs was in February 6th. But almost a quarter of all the volume on February 6th involved a multi-leg trade. And that was split between 40% calls, 60% puts. And it looks like, there was a small amount of trades that were contingent, which most likely means, there was a stock component to that trade. And then here we see how those trades were executed. It looks like 99.8% of them were electronic. There was some floor trade in there, but it was small compared to the overall volume, right? Then we could come down here, and we got a few charts. So the chart here on the left, it gives us a volume bar for that. Remember, we're always on this February 6th expiration, and it tells us, gives us a volume bar by the strike. So if we hover over, we'll see the 493 strike saw the most option contracts traded yesterday on the February 6th expiration. And we could see that there were more calls than puts. The count is there, 93,000 puts versus 128,000 calls. And the calls are in the yellow bar, and the puts are in the purple. Okay, so you could see them stacked. So the total volume on those strikes. And this is just quickly, it shows us the distribution of the option volume, right? So you could see here that a lot of it's centered kind of around the 493. So a lot of the volume is clustered around there, 493, and the strikes around it, right? Which yesterday was, the at the monies. So let's come down here. So you could see a lot of the volume is around at the monies. And then visually, what we could also see is how the color is just, because remember, the yellow are the calls, the purple are the puts. And if we see going up from that, the money, the strikes going up, that the majority of the volume is in the calls, right? You guys see that yellow? So this is the way things are trading. We're trying to understand how are people using the options and how are they trading. And we see that, that the majority of the volume as we go up in strikes. From that, the money are mostly in the call options. And then what about the options on the lower strikes? And those look like that the majority of those contracts are in the puts. Right. So that's how we're seeing the split of the option contracts. Overall, we see there are 52% calls and 48% puts. That's overall. So almost evenly split if we look at all the option volume on that expiration. But when we look at this chart, they're not evenly split by strike, right? It doesn't look that way. So when we look at the distribution of it, well, wait a second, if we only look at upside strikes, then the vast majority of them appear to be in the call contracts. And if we look at the lower strikes, especially as you go out further and further out of the money, the vast majority of them are puts. All right, so that's how the option activity looked like yesterday. All right. Now let's go to the chart to the right of that. All right, so that's how we read this chart. Let's go to the chart to the right of that. And here, what we're seeing is, again, these are volume bars for the options. They're stacked calls and then puts, right? So the puts on top of the calls, the yellow is the calls, purple is the purple or blue. What does that look like to you, Will?
Blue.
Are the puts. And what this lets us do, this chart, is it breaks it down by time of day. So it's in 5-minute increments, and it shows us the volume in 5-minute increments and how it traded throughout the day. So here, what stands out right away is over here, right? If we hover over it right at 10:15, 10:20, there was a big spike in volume. That looked like, as far as time of day, saw the most activity for that 5-minute interval, right? And there's a lot of also volume around that 5 minutes. So it could be, we'd have to go back and look in time if that's usual or normal, or maybe something around that time may have happened. We could take a look at if there are certain reports that came out that were, because we're looking at SPY, that were relevant to the entire market. I don't know if and one way we could do that is actually go to this news and look up the economic calendar. But I'll just leave it for now. So that's that's one thing that we could spot from this particular chart. And we could just see how the volume trends, from the beginning of the day to the end of the day. And what it looks like from this chart is that the start of the day, the very morning, seemed to be the busiest as far as trading volume. And then it looks like around noon, the trading volume started to decline. And towards the end of the close, it upticked a little bit. So most of the volume yesterday was really concentrated at the start of day, and there was some kind of surge around the 10:30 time period. Okay. So that's, if you're interested to go back and see, well, let me go look at the time in sales around 10:30, what traded, what may have caused it, because you want to try to explain away that volume. Now we could go down here, and this is the last chart, and it shows how the volume looked like from day to day in this expiration. So we're looking at the February 6th. It looks like it got listed somewhere down here, January 23rd. Right. So this is since the inception. And here we kind of understand, how the volume progresses in this expiration. When it first got listed, January 23rd, obviously it had more days to go, DTE. We saw barely any trading. Same thing, January 24th, January 25th, 26th. Only as we get closer to expiration do we see volume start to pick up. So you could see January 31st volume. We started kind of seeing a little bit of uptick in volume, and it really started to soar once it reached 1 DT, maybe even 2 DT, but 1 DT, 1 day to go. That's when we really saw a pop where the interest in trading these options started to increase. And that shows us what traders, or how those options are being used in SPY, right? That it appears to me that a lot of the strategies, a lot of the use cases in SPY seem to be concentrated around the very short-term options, 0 DT and the 1 day to go. So that's how this February 6th volume. Okay, open interest, we could take a look and we see 479,000 contracts are open on February 6th. So we could click on that, and this shows us 2 different charts. The chart to the left, it shows us the open interest by strike. And again, this is the put stacked on top of the calls. And what it allows us to do is spot any large or concentration of open interest on a particular strike in this expiration month. And there seems like 2 of them stick out here. I'm going to hover over it. This one, 488 strike, which it looks like 73% of those are in the calls, 29,000 contracts open, 10,000 in the puts. And then the next strike, we could just hover over it, is the 495 strike, with 89% of the contracts are in the calls versus 11% in the puts. So those are the 2 biggest ones that kind of just stick out. And again, that could point it to something, and we could go back and try to trace what led to that open interest. I'm not going to do that right now because it'll be probably, require another like half hour going through this. But now you could spot it, and now that could point to something. Well, what led to this large increase in open interest on those particular strikes? And then the chart and also by the colors, yellow for calls, blue for puts, we could see how the calls and puts are distributed by different strikes, right? So what do we see here? That as we go out in strikes, there is a bigger concentration of call open interest, similar to how the volume was traded yesterday. And as we go further down in strikes, it looks like that the majority of the open interest is in the puts. So even though we have 58% overall, 58% of open interest are in calls, 42% in the puts, it's not evenly distributed around different strikes, right? That's not how it looks. It looks like, you know, more calls on the higher strikes, more puts on the lower strikes. And if we now go to the next chart, this shows us the open interest in the expiration overall by date, right? And did the open interest, increase, decrease? Did it look linear? Does it look like exponential, like over here? And we see that open interest, doesn't increase linearly. It increases similar to what the options volume actually looks like. As we get closer to the expiration, that's when we start seeing big increases in open interest. And again, all these visuals point to how people are using options in SPY. All right, so that's the open interest tab over here. So I have a couple. I'll try to do this one, just to end it, and then we'll move on to a different report tomorrow. So at the money straddle, besides the volume, another thing we want to try to determine is, well, what are the option premiums like in SPY? So over here, this shows, based on the last snapshot that we took, what a synthetic at the money straddle would cost. So when I say synthetic, if we look at the monies, right? At the monies would be something that's exactly lined up with the stock price. So in that case, $492.55. However, we don't have strikes that are exactly every penny that the stock moves. You can't find an exact match. So what we'd have to do is create a synthetic straddle based on the options that surround this strike. So whatever, we're going to look at the options that surround 492.55. It could be a 492 strike, 493, whatever. We're going to look around it, create a weighted average methodology to come up with, well, what is the most likely implied volatility for this 492.55, and what would the straddle cost? So that's what's happening over here. And this allows us to quickly assess, well, yesterday where did the options close? So that at the money straddle implies a move of 0.4% up or down. You bought the call, bought the put, that's how much the market would have to move to break even, 0.4% for the buyer and seller, which translates to a $2.19 move. So this way we could even compare, going down how much, because obviously as you go out further and further in time, you're going to have more premium in them, right? You have more time for the stock to move. And we could just eyeball and going down in expirations. These are the days, business days left, how much the straddles are being priced at in percentage terms, and then we take that percentage and translate it to dollar terms based on where the spot price is. So, well, I think we're right up at 9:30. I'm going to leave it there.
Dee, we did have a question that just popped up. Maybe we can look at it tomorrow. Ivan asks, hi, Dimitri, does this imbalance, more puts on lower strikes or more calls at higher, reflect market decline in the near future? So do you want to answer that question tomorrow? Or
yeah, and I don't think that's what it's reflecting in SPY, because you usually see, if you look at these data points from day to day, this is what you usually see. And in SPY, it's S&P 500. It's just normal people use that as, protecting portfolios, and one way to do that is to buy puts in SPY. So it's typical. When we look at this type of distribution, this is from day to day. I feel is what you typically see. That's kind of the order flow that you typically see in SPY.
So it could be different in an individual stock.
It could be, yeah. Could be a different why, something pops up, that's unusual. But, just knowing in SPY, from my experiences, that
This
is not
seems
an
to be the
unusual
normal order flow.
Yeah, this is not unusual to see. This is just typical order flow in SPY.
All right, Ivan, I guess that answers your question. Great job, Dima. We
Yep.
will meet same time, same place tomorrow. Thanks, buddy.
Yep. All right. Thanks everyone for joining. Stay safe out there. Have a great trading day, and hope to see you guys tomorrow.
Trade in peace, community.